So Chen, we've helped a lot of families over the last few years, and I think it would be important actually just to highlight a couple of the examples of the ways that we've supported folks.
Yeah.
And one of the families that we supported, which I thought would be a very good one to highlight, that I asked you to kind of just pull up your notes for, was actually that family that they were a couple, very successful. They had run some operating businesses. They were in their 50s, early 60s. They had accumulated, I think, somewhere around like $6 million in net worth. They had kids. But interesting for them, they were also, which I love, they were consistently contributing to charity. They had a charity that they really cared about. I think annually they were contributing about $25K.
Yeah.
And they came to us because they ran into a sticky situation where they just didn't plan for this, but they never really thought about their estate tax bill.
Yeah.
And then they were getting increasingly concerned because that tax bill seemed pretty hefty.
Exactly.
And they weren't sure if they could continue to support the charity that they wanted to.
Yeah.
While at the same time, as all parents, they want to pass down everything that they have to their kids.
Right.
And they came to you to see if there was any kind of solutions or thought processes that you could help them with. And you were able to actually do something incredible for them. And I thought that was one thing that we should highlight. So do you maybe want to speak a bit about that?
Why don't we maybe start with the estate tax implications in itself? I think we speak about that quite often. I mean, the reality is that, clients there's usually two types of tax implications, right? One is people want to minimize taxes today on an annual basis, but there's also the estate taxes piece of it. A lot of people focus on how to eliminate taxes today. I mean, whether it by contributing into an RRSP, and there's many other strategies that's a normal focus everybody has. What a lot of people don't realize is they work so hard to build wealth in general, but they don't necessarily spend the same type of energy to protect it, preserve it, and transfer it to the next generation. And this is where the estate tax liability really comes in, right? So from a planning perspective, it's important because what CRA does is when one spouse passes away, let's say if there's a married couple, for example, when one spouse passes away, a lot of assets in general typically will roll over to that second spouse on a tax-free basis, or there's a provision called a spousal rollover provision. But when the second of both spouses pass away, there's a huge tax implication because CRA will deem that the assets were sold at the fair market value, even if it's your own children. So the assets were sold from you to your children. And usually what happens is whatever the growth in that value of your estate has, let's say you built a $5 million empire, but you started with $1 million, that growth of $4 million as an example is now considered a deemed disposition, and therefore it is actually taxable. So as part of moving wealth from one generation to the other, there's a huge tax implication, and that erodes people's wealth in a significant manner. And that's one thing that this family was extremely concerned about, because when they learned about these concepts, they realized, hey, they love the idea of giving, but they absolutely don't want to give to a charity at the expense of taking it away from their own children.
Yeah, and I think it's interesting because what you're talking about is not necessarily things like wills and whatnot, right?
Yeah.
A will is an instrument that just more so outlines in legal terms like where your assets go, etc. Right? And most people, at least the ones that I speak to, just accept that, okay, well, I have to pay these taxes now, and I have to pay these taxes, etc. But what's interesting and innovative here is there are fully CRA compliant strategies where you have kind of discovered, or you kind of advocate for strategies where, if done and structured properly, that they could probably retain majority, in some cases all, of what they've earned,
100%.
while still benefiting other things like charities and fulfilling their inheritance requirements and all that stuff.
Exactly.
Right? So in this specific case, if we took it as summary, I really want you to kind of walk through the mechanism of your strategy here. So $6 million in net assets, net worth. They have kids. They had a $1.1 million estate tax liability. That was triggered by 2.4 million capital gains projection. And they wanted to continue to give the $25K annually they do to that charity. With obviously a hope that they would be able to give more as time went on. So how did you structure your solution?
The most important thing, and sometimes we miss this in terms of planning for, and it's really important, is in addition to the capital gain implication, there are also probate fees that have to be paid in every province. These are fees that you actually now have to pay to the court system for them to go through the probate of the will or probate process from a legal perspective. In addition to that, there's also executor fees. Typically, that's a portion of your estate, so it's sometimes anywhere between 1% to 3%, is typically paid to a professional executor sometimes to manage that entire estate planning process. And what that usually means is you might think you might have a $6 million estate in this particular example, and we know there might be a tax liability of $1.1 million that had to be paid out. But and that's really about 15-20%. But when we now take into consideration probate fees, executor fees, all of that stuff, that's almost 25% gone right down the drain from a lot of the hard work that this particular family put in. So that's what we want to be able to mitigate, because we really want to make sure if we can do some intentional planning, we can essentially figure out solution that can help them preserve a lot of that.
Yeah, no, that makes sense. And so if that was the circumstance going into which was causing the tension, and those are the ingredients that we have to kind of work with for that specific family. So how did you, what was the structure of your strategy?
Yeah, it actually followed a two-part structure. Okay. So the first one is, how do we continue to give today in a tax-efficient manner? Because a lot of people are typically used to the idea of donating cash or checks, or cut a check, for example. What if I actually told you that was probably one of the, giving cash sometimes is probably one of the least effective ways to give for you as a donor. And I really mean that from an after-tax cost perspective for you. So, because we give because we have a natural intent to give, but there are also tax benefits that come with giving, and there are much more smarter tax-efficient strategies to giving. So one of those strategies is actually gifting appreciated securities. So simply, we actually took this family's circumstances, and they had a lot of appreciated securities that they've sort of grown over the last 5, 10, 15 years. And what we did is we said, hey, instead of giving cash, can we maybe allocate a certain portion of your stock portfolio as a donation? If we take the same $25,000 example, what we realized is that for a market value of $25,000, this particular family, their acquisition cost or book cost was only about $5,000, which means they invested about $5,000. It's now worth $25,000 after so many years. The typical process is people would redeem that $25,000 from that non-registered portfolio, and then they might actually donate. But the unfortunate tax impact of that is, if you were to redeem that $25,000, just because you made a $20,000 profit now, that $20,000 is now taxable. And that's usually about $5,300, give or take, if you're in the highest marginal tax bracket, given that there's a capital gain, a taxable capital gain, and the actual liability, which is about $5,300. Instead, if we now actually donate those $25,000 worth of shares directly to a charity, what it actually does is when the charity actually redeems those investments, they actually pay $0 in taxes. So it's a much, much smarter strategy, because you not only save the $5,300 in capital gains you paid, but the reality here is that many, many years ago, you only started with $5,000, but now you're actually, that's the equivalent of that is now donating $25,000 to a charity, which can ultimately access all $25,000 without paying a lot of taxes. So that was the first part of the strategy, which is, hey, instead of donating cash, can we actually donate appreciated security and make sure that the generosity is still the same from a client's perspective. And the impact in terms of the benefit that the charity is receiving might be the same as long as the client is willing to do the net $25,000. But the after-tax cost of that donation for you as a donor is significantly advantageous from when you donate appreciated securities rather than donating cash. So that was the first of the two-prong approach to this particular solution.
So that dealt with their intention to want to continue to contribute to the charity, and you obviously clearly have discovered a way that, or advised of a strategy that was a lot more tax efficient for them,
yeah,
while the charity still received the full benefit of what they want to give them.
Exactly.
Yeah.
Exactly.
Okay. And part two?
And then the second part of the strategy is now actually dealing with that long-term problem that we have. So we've determined that their tax liability is $1.1 million. So really, if we don't do any planning whatsoever, they'll end up paying that $1.1 million. When I say they, the estate will end up paying that $1.1 million to CRA anyways. So what we actually wanted to do was use actually something called a permanent participating life insurance strategy. So what a participating policy does is a portion of your insurance premium are typically invested into an investment account called a participating account, which is managed by portfolio managers within these major insurance companies. And typically these policies, while they're not guaranteed, but they do pay annual dividends. And very similar to the DRIP concept in the investment world, what the annual dividends actually do is they actually help the policy owner purchase additional life insurance on an ongoing basis. In this particular example, we started off with $1 million policy, and we projected that, hey, over the next 20, 25 years, let's say approximately at the age of 85, that value of that policy will now be $2.4 million. Again, never guaranteed, but projected to be at that particular amount given the current dividend scale. What happens is when we structure it the right way and we ensure that the beneficiary is the charity, that $2.4 million that gets donated to the charity at that time will trigger a significant amount of tax credits to the estate. So typically speaking, that $2.4 million donation to the charity would trigger a $1.1 million tax credit. The most important part here is we did structure this policy as a joint last to die policy. So really, because we've established the fact that when the first spouse passes away, there may not be a huge tax liability because a lot of the assets roll over to the second spouse. So really the tax implication comes in when the second spouse passes away. So by making sure we have both insured on the policy and the payout is triggered at the death of the second spouse by structuring a joint last to die policy, we make sure it coincides intentionally by planning it for the tax liability. But the best part we did here is we actually made their favorite charity the beneficiary of that policy. The way the calculation worked for this family, that particular policy was a 10-pay policy, which means you've paid off in 10 years. After 10 years, you don't make any payments, but the coverage is there until they pass away. And the annual premiums on a yearly basis was $65,000. So they're spending about $650,000 in that period of 10 years, but their projected payout may end up being close to about $2.4 million.
And the growth of the dividend account associated with the policy, there's no capital gains tax on the growth.
That's right.
And why is that?
It is tax deferred, very similar to how TFSAs and RRSPs are governed by the Income Tax Act, through the Life Insurance Act, or Insurance Act in general. Participating life insurance policies have privileges very similar to that of TFSA and RRSP to be a vehicle that's actually completely tax exempt as long as it's structured correctly and it's passed on to the next generation in the right way.
Oh, that's very helpful to know.
So without any planning, $1.1 million would have gone to the CRA, but with some intentional planning, we've effectively reduced that tax liability to zero from a family perspective. The second part of it is the family would have paid 1.1, but instead they paid $650,000 into this particular life insurance policy, but that essentially guaranteed that the family doesn't lose any value to their children. So they make sure all of their wealth is left to their children and not to the CRA. But the most important part here is an additional $2.4 million of value, meaningful gift, is now left to the charity that they truly care about, essentially defining their legacy.
I think that's great. And so you definitely were able to walk them through this solution, and I know that they were very happy with it. What would you say for families who, people who are watching or who may no one's going to be in the exact similar situation, but
yeah,
I think there are quite a lot of people who are maybe haven't really thought about long-term things like what their estate tax bill could look like.
Yeah.
I'm not sure if they're of the mindset that they're just going to pay the tax and just try to focus on today's taxes and not really give any thought to future.
Yeah.
But maybe there are people that are thinking like that. Maybe others are actively looking for solutions because
Yeah.
they are already considering it, to either one of those groups,
Yeah.
right? What would you tell them? Like, how would you, what would be your message to them?
Yeah, no, I mean, this is exactly why we work really well with accountants and lawyers just in general, because accountants are typically focused a lot in terms of how do you minimize taxes for today, just in terms of whether it's your bookkeeper or an accountant from a corporate perspective, or whether it's filing your income tax return. The focus is about minimizing the taxes today, versus we actually love the idea of ensuring that, hey, not only should you minimize taxes today, but you should also look at how do you actually minimize the taxes from an estate planning perspective, or when you're planning to transfer your wealth from one generation to the other. We would love to help you, in all honesty. Like, there's many planning firms like us. We take a very holistic, integrated approach that ensures that, hey, can we first meet with the client to understand what exactly is their objective, right? Like, like I said, everybody will have different goals and objectives in terms of what they want to accomplish. For some, it might be minimizing taxes. For others, it might be like this family was very keen on making sure their family is able to inherit a lot of wealth, at the same time leave a charitable giving strategy, or leave a lasting impact to the charity that they truly care about. Sometimes it comes down to, hey, like business owners having multiple partners and looking at exit strategies, and then looking at how do they minimize taxes while they're exiting from business. So we truly want to understand what exactly is your goals and objectives first, right? So we typically do an introductory meet and greet, understand what those objectives are. Then if there's a synergy between the client, if we feel like we can actually help the client, we would then obviously schedule a discovery meeting with the client. And usually that discovery meeting is pretty in-depth. We understand a little bit about where you are today, everything from financial holdings to personal assets to everything else. And then we also figure out, hey, where is it that you want to go? What does that end game looks like? What is your ultimate strategy from that perspective and from a legacy planning perspective? Once we know these two pieces, we would then be able to craft up meaningful strategies in a wide variety of spectrum, and really make sure your accountants, lawyers are involved as part of the process. Because one of the things that unfortunately we do see quite often is accountants, lawyers, and planners work in silos and not together. So we take pride in making sure that our clients and their accountants and lawyers are actually involved in the process, and we actively encourage our clients to make sure that they're actually conversing with all of us before they implement solutions that we strategize.
No, I think that's great. I think that's great that you have this depth of knowledge. I think it's great that you are in a position to quarterback the solution, especially working with different subject matter experts. And if they don't have it, they can work with you and your team directly.
Right.
And I hope that those watching and those who might be in need of kind of reaching out to you decide to do that.
Absolutely.
And I'm sure we'll be talking about more case studies in the future.
Yeah, absolutely. We'd love to.
Okay.
Awesome. Thank you.